for telling you that the trend is ending. It gives you some clues, some early alerts, but not all turn into turns in the trend. We're going to add to that another couple of indicators that are provided by Vantage Point, and that is the predicted medium-term difference and the predicted long-term difference. They're in that bottom panel also. Again, the difference is the difference between a predicted moving average and an actual moving average. The medium term is the blue line, which compares medium-term averages. The green line is the long-term moving average comparison. So you can see how they move back and forth, typically in line, of course, with what is going on with the moving average up above. But you'll also notice that they tend to turn a few days frequently ahead of the actual moving average or the actual prices, providing an alert that something may be happening. We'll take a little bit more of a look at that when we talk about after we have added another one. What we want to do now is we want to add one of those that I think is very helpful in terms of what specific price am I going to use to act to get into and out of a market. And it does add another couple of lines to this chart, but can be very helpful lines after you get used to them and if you don't get confused by which lines are which. In this case, we have the predicted high and the predicted low. The predicted high that you see there is that gold line or orange line, or whatever you'd like to call it. That indicates the predicted high. The predicted low is that pink line or that fuchsia line that you see that kind of runs along the bottom of all the prices to indicate what the predicted low is going to be. This is predicted one day ahead, so it does give you kind of a specific point where prices might head the next day. And what the the next day when you have to act. You have to, of course, have a day's worth of data in before you get that indication. But we'll discuss how you can use that as a point to get on board to be ready to take advantage of a move when it does occur. Now, the main reason that we like to have a stop in place to potentially buy ExxonMobil, as I mentioned earlier, is because at this time is its proximity to that low over a long period of time. I mentioned that if the market falls, if we have a situation where all of a sudden we have a collapse through this area here in ExxonMobil, that could be kind of a bad omen for all of the stock market. I'm not predicting it because I'm not in the business of trying to predict where things are going, but I'm trying to react to what does happen if it does go there. So, I want to be ready, and that's why, this is a situation where you want to have some kind of a situation where you're prepared to have a stop in place to buy or some other way to go long ExxonMobil, and that's mainly because of the location where we're at on the long-term charts at this point. Couple of ways to use what the indicators we have here. We won't talk too much about going short because that doesn't seem to be everybody's favorite thing to do is go short, but we're mainly going to focus on the situation we're going long, and we're ignoring this May 6th data. I mean, that's kind of, as I said, an aberration that we're couldn't have done anything about, couldn't have caught anyway, but that data does factor into the prices over a period of time. But we're going to look at a period of time where we have the predicted high and we have a situation where we have been trending down. We've gotten down close to the previous lows, and we're going to use that predicted high as a point at which we will kind of set up our criteria for where we want to buy. In the case of ExxonMobil, the average daily range has been some days, of course, ignoring again that May 6th date. Sometimes we have $2 ranges, sometimes 50-cent ranges or whatever. So just kind of an arbitrary choice, and you may have other ways that you like to do it if you do your own experimenting, but we're going to use $1 above that predicted high as our buy point. And the reason for that is because, as you are well aware, if you've traded any at all, you know how the market sometimes will try to fool you into thinking something is happening, jabs up, and then fades back down, and you get stuck with a position that you don't necessarily want, or a position that is not at the right price that you would like to buy. So in this particular case, on May 27th, we had as I said, we had a predicted high right here of 60.05. So if the market gets to 61.05, then we would try to be a buyer. And that did occur in this right in here. Not precise, but in that vicinity right there. 61.05, we would try to be long the ExxonMobil stock. Again, here's another situation where how big an account you have and your perception of risk and your tolerance for risk will determine the size of your account. In this case, I'm saying that if we had a $20,000 account, we want to risk no more than 3% of that account on any one trade. So 3% of 20,000 would be $600. So we're going to say we're going to risk $600 on that trade. Now, we can make that 100 shares with a $6 leeway to go down. We could say, okay, it could be 200 shares, and we're going to put our stop $3 below that 61.05 entry point, which would put it at 58.05. And of course, one of the nice things about putting it at 58.05 is that we are, right in this vicinity right here, where those previous lows occurred, and that is probably what we would try to do if we had our druthers. We'd like to have, a couple of hundred shares because it gives us some more flexibility if we do want to get out with some partial profits as we're moving along. Now, keeping in mind, again, we said we were only going to risk $600, but when you're looking at your account, your $20,000 account, and if you're buying the stock and you're paying full price for it, you have more than $12,000 of your $20,000 committed to this one stock, or if you're buying on margin, a 50% margin maximum, $6,000. So that's a pretty good sized chunk of your account, and you may not want to do that just simply because you'd need more flexibility for other opportunities that may come along. So it's up, it's going to be a little bit up to you to decide, the size of your position and depending on the size of your account. When we get into watching this trade a little bit, we kind of watch it go along. We have situations occurring below here. We have the situation I mentioned before about the crossover types of situation that we have with the predicted differences. We have the predicted